Medi's shareholders and other participants joining us from India and from other parts of the world. My name is Dr. Vikram Chhatwal. With me, I have our CEO, Mr. Satish Gidugu, our CFO, Mr. Matthew George, and of course, you have already been introduced to Neeraj Didwania, who heads our investor relations. The health insurance sector in our country continues to grow, supported by tailwinds, including regulatory commitment to enable insurance for all by 2047. This push by both the government and private enterprise will continue to have tremendous positives for the TPA industry. As a company, we continue to create newer value pools in the industry while we maximize our participation in the existing ones. The recent news about composite licenses for life insurers and a possible downward revision in the applicable GST on health policies, if it's implemented, will be a win-win for all stakeholders and most importantly, the common man and policyholder. I would like to share with you key highlights for our company performance for the period ending December 31st, 2023. The total premiums under management for the company was at 14,163 crores, a growth of 35.7% over the corresponding period of the previous year. Further, if I break this down, the group segment, which is a key part of this premium growth, was at 12,352 crores, a growth of 34.5% on a year-on-year basis. And the retail segment was at 1,811 crores, a growth of 45% on a year-on-year basis. Our share of the total industry health premiums, which include both group and retail as shared with you earlier, was 20%, delivering a growth of about 230 basis points over the corresponding period of the previous years. Within this 20% market share, our share in the group segment is higher at 29.3%, delivering a growth of 300 basis points on a year-on-year basis, and our retail segment was at 6.3%, which is a growth of 110 basis points on a year-on-year basis. I now hand over to our CEO, Satish Gidugu, to share the business and technology highlights for the period with you.
Thank you, Dr. Vikram, and a warm welcome to all Medi shareholders and other participants. Thank you for joining this call. Let me start with some of the business highlights for the 9 months ended December 2023. Medi TPA, a wholly owned subsidiary of the company, added one new standalone health insurance company as a customer for group segment. And Medi TPA has also commenced working with a marquee life insurance company as a customer to service their health rider policies. Mayfair We Care, a subsidiary of the company, extended relationships with some group accounts for managing their overseas benefits, showing early signs of synergy with the acquisition. We retained over 90% of Advantage TPA's corporate accounts with no major losses post-acquisition. Raksha TPA, another subsidiary of the company, successfully in the process of transitioning claims operations to Medi technology platform. And our focus on network expansion on a pan-India basis continues towards increasing cashless penetration continuously. Business from our government segment is continuing to perform in line with our expectations. And with respect to technology highlights for the company, we emerged as the leaders for National Health Claims Exchange integration, which is an initiative by the Government of India, enabled by NHA and the IRDA. We've completed successfully all of the integrations across multiple insurance partners. We are developing a proprietary technology platform for Mayfair We Care, our global TPA, addressing the international private medical insurance market, enabling both cashless network management across the globe and also the ability to handle multi-currency transactions. And in the same period, we've also integrated with multiple digital platforms and aggregators to enable cashless benefits in outpatient healthcare services in India. And our revenue per average headcount continues to move up. On non-government contracts, this number now stands at 1.03 million rupees for the period. I would now like to hand over the call to Matthew George, our CFO.
Thank you, Satish, and a warm welcome to all the participants. We'll first cover the results for the 9 months ended December 23. Total income was 482 crores, a growth of 26.9% over the corresponding period of the previous year. Revenue from contracts with customers, which is excluding other income, was 468 crores, a growth of 26.8% over the corresponding period of the previous year. Revenue contribution from contracts with customers included, I'm talking about the composition, 9.6% of total revenues from our government business line, 5.9% of the total revenues from our Mayfair WeCare business. India TPA benefits business, excluding government and international benefits, has grown at 21.1% over the corresponding period of the previous year. Now, when you come to adjusted earnings before interest, taxes, depreciation and amortization, this is excluding other income, was 96.3 crore, which is a growth of 8.6% over the corresponding period of the previous year, a margin of 20.6% on revenue from contracts with customers. PAT for the period, this is prior to adjusting the exceptional item, which is the employee incentive scheme of 21 crore, which was reflected on our 6 months financials, was INR 66.6 crore, a growth of 14.3% over the corresponding period of the previous year, a margin of 13.8% on total income. Adjusted EBITDA and profit margin was maintained while absorbing the incremental costs from integration of acquisitions and the accounting impact of amortization of intangibles due to the acquisitions. Net worth was 439 crores as on 31st of December 23, as compared to the 388 crores we had in the corresponding period. Return on net worth for the period was 10.3% as compared to 15% in the corresponding period of the previous year. Return on capital employed, ROCE, was 16.2% as compared to 19.4% as compared to the corresponding period of the previous year. We will now get into the financial highlights for the quarter ended 31st December 23. Total income was 169.8 crore, a growth of 29.2% over the corresponding quarter of the previous year. Revenue from contracts with customers, operating revenue, which is excluding other income, was 165.9 crore, a growth of 32.3% over the corresponding quarter of the previous year. Adjusted earnings before interest, taxes, depreciation, amortization, excluding other income, operating, which we define as operating EBITDA, was 33.9 crore, a growth of 10.4% of the corresponding quarter of the previous year. EBITDA margin, calculated as operating EBITDA divided by operating revenue, was 20.4% for the quarter. Profit for the year, for the period, was 21.3%, flat over the corresponding, which was flat over the corresponding period of the previous year. Profit margin as a percentage of total income was 12.5%. The cash on the balance sheet is about 167 crores versus the 144 crores for the 6 months ended September 23. Thank you. I will now hand you over back to the leader.
Thanks, Dr. Vikram, Satish, and Matthew. We can now open the call for questions from the participants. If you have any questions, please direct them to Dr. Chatwal, who will in turn ask the concerned team member to respond.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Chintan Sheth from Girik Capital. Please proceed.
Hi team, thank you for the opportunity and congrats on the decent numbers. If I look at the gross premium under management for the quarter reported, it stood at 14,000 crore versus 10,400 crore last year. But if I look at DRHP which we released, RHP, that number for September was around 9,500 odd crores. So is there any seasonality in terms of premium collection or premium under management, or how should we look at it? And because the base is kind of moving, our revenue also tend to have some seasonality. If you can help us understand on that part.
So I will. Neeraj will respond to this.
Hi, Chintan. So the half yearly number at 9,000, if you see, it was already at a run rate of a quarter being more than 4,500.
Right.
So this 14,000 that we are reporting is in line with how we've been growing. So it's no seasonality or there's no one-timers there. It's just the trend that we were already reporting in the first 6 months.
Okay. And in terms of revenue booking, is there any? It doesn't translate into, because if I look at your second half for the last year, we are looking at around 52% revenue generated during the second half last year, of which it, implied number looks like 27% revenue comes in the 4Q. So I'm just trying to get a sense on that part. Second, if it's not seasonality, then second question is on the margin front. If you can, ballpark split between the base business, where were we in terms of margins? Second is the new businesses which we acquired are low margin. How much those business Raksha and the Medi, sorry, I forgot the second acquisition. But both the businesses contributed how much of revenue and profitability? And third, if you can call out on the one-time expenses related to the listing side, which won't trigger going forward, so that we can get a sense on what is the base margins of the business.
Sure. I'll ask Satish, our CEO, to respond to this. Thank you.
Thank you, Chintan. So, just try to address your questions one by one. Like you observed, while you observed that there was about 52% in last year, there is no major seasonality in our business considering the size at which we operate today. And of course, with the acquisitions and with the continued acquisition of business, there could be minor changes in the way the quarterly premiums actually move. So that's less of a seasonality effect. And second, from a margins perspective, of course, when we have three integrations that we were pursuing during this period, Advantage TPA, Raksha TPA, and Mayfair WeCare. Like we've said, typically these acquisitions take us between 3 and 4 quarters to completely synergize and into our operating template. In fact, the third quarter was the first full quarter of Raksha integration, which is a material integration for us.
Correct.
And despite that, if you recollect, end of H2, when we presented our numbers, we were at about a 20.66% on the margins, and we've held margins despite the integration that was going on, in third quarter. And we beginning to see the synergies, kick in from all of the integrations. Right? While we don't, because of the way we synergize common operations and technology, we don't necessarily report margins separately by each business. But it would be fair, just from an approximation perspective, to say that there's about a couple of hundred basis points of margin impact, which is temporary, that is coming in predominantly because of the ongoing integrations. Now, for the next 3 quarters, yeah.
Yeah. And on the one-time, listing related expenses, if you can, just call out what has the impact on margins because of that as well.
So I'll ask Matthew, CFO, to respond to this. Matthew.
So the listing expenses, Chintan, is entirely it was an oversight, as you are aware.
Right.
And we treated it as a recoverable from promoters. We have recovered one part of it. The second part of it is lying in the escrow account, and we expect to get the money back in a couple of weeks' time. There is no impact on our P&L for any of the costs that was incurred during the process.
Okay.
Yes.
Great. Sure. I'll join back in. Thank you.
Thank you. Next question is from the line of Sindhil Kumar from Joindre Capital Service. Please proceed.
Good evening, sir. Am I audible?
Yes, you're audible.
Thanks for the opportunity. My first question is, recently the General Insurance Council has launched a cashless everywhere scheme, right? Under which the policyholder have freedom to choose any hospital that may not be a part of insurance company's network, right? So I just want to know what kind of impact we can expect from this initiative in the long run, sir. And the second thing is, do we see any increasing competition because of this initiative?
Sure, thank you for that question. I'll ask Satish Kirigu, our CEO, to respond to that. Thank you.
Thank you. I think fundamentally it's a great initiative to improve the policyholder experience. For us, given that we work with 27 insurers and 21 of the insurers use our network tends to be a superset of many of the insurer networks today. As a result, today, only about 15% of the claims that reach us are from a hospital that we don't already have a relationship with. And clearly, this is an area where, given our wide range of contacts across the country, we are able to convert what historically used to be reimbursements, into cashless much faster. And we are fully prepared and integrated with all of the insurance companies to support this model. I think you had a second question on the competition and the impact. We like to think that one, it is about the core cashless network, which we continue to expand at a significant pace, so that our policyholders find a default network hospital and do not have to necessarily go to a non-network hospital and then ask for an ad hoc cashless, which may not be as effective. So we will continue to focus on expanding our network, and we like to think that our technology integrations with hospitals and our superior turnaround times will continue to be a competitive advantage irrespective of where the cashless comes from.
Okay, understand. I have a second question. What is the percentage of fee we charge on premium under management for retail policies as well as group policies? Percentage of fees we charge.
It is, I think it's best to think of our yields as by product, by insurer, because each product has a different construct, different level of operating workloads for us as an administrator. So it's a wide range, going anywhere from a 2% to a 5.5% today by product, and the blended yields are based on just the products that we serve at the moment.
What is the yield as on December 31st, 2023?
I think we've not published that. We're happy to leave this with you for a later conversation.
Okay, understood, sir. Okay, that's it from my side. I'll join the queue. Thank you.
Thank you. Before we move to the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1. Next question is from the line of Rishabh Shah from RBSA Investments Manager. Please proceed.
Hello.
Yes,
Hello.
Go ahead.
Yeah. Hi, good evening, sir. I just wanted to understand how competitive are we in terms of the cost of providing the DPA service versus a company which is in-housing the DPA. So we just give ballpark range in terms of percentage.
So, Satish, would you like to answer that?
Okay. No, so If you look at the fact that we work with 27 out of the 28 insurers today that offer health insurance service, clearly we are ticking all the boxes in terms of us being cost effective and also helping insurers improve and continue to maintain their retention rates with a good mix both of customer retention and more importantly managing medical inflation. So a choice of a TPA goes beyond just the application of the fee, but it is a combination of the technology, the access, the cashless, our ability to manage medical inflation in a predictable manner. And we like to think that as Medi Assist, we are very competitive on all of those.
And just to support what Satish said, this is Vikram. I think an important piece for you to look at as you understand us as a business is the fact that sequentially every year over the last decade, the share of TPAs in servicing the overall premiums sold every year in the country has continued to grow. And so today that sits at about 55-56% and is expected to grow by 2028 in market projections to about 61-62%. And so essentially I think that the continued role for TPAs is there. We share that TPAs in terms of servicing the overall health premiums continues to grow. And this is also supported by the fact that the products are getting more and more complex. Today especially, not only are products in the inpatient market, but you will see products that are increasingly offering outpatient service capabilities. And I think Medi Assist's ability to not only drive the cashless anywhere equivalent in the inpatient market, but the cashless anywhere equivalent in the outpatient market has clearly been an outstanding differentiator when compared to other participants, whether in-house or other TPAs in the market. Thank you.
Thank you for this answer. Secondly, I just want to understand, I assuming that we don't have any role to play in the offline claims channel, whether that is through an agent or directly through the company. I believe we are more of an online player. So I just want to understand if you could share some breakup of the total insurance claims that are processed. How much is through offline and how much is online, and what is the trend in the last 3 years?
I'll ask Satish to answer that for you. Thank you.
Yeah, thank you. So I'm just, with permission, I'm going to correct your understanding a little bit here. So when we work with a insurance company in a portfolio, it could be a group customer or a retail product portfolio, we manage 100% of the claims, irrespective of how they're actually submitted to us. As a technology-first player, we have enabled significant amount of online transactions and digital transactions, reducing paper movement in the industry. So for us, it's more a metric on how much customer experience is improving, how quickly hospitals are getting paid, but our claims processing or remuneration is not dependent on whether it is submitted online or not.
Okay. And just last, wanted to understand the thoughts. If this in a composite insurance, there have been talks that if it comes by, how will this industry dynamics change for us if at all it happens?
Yeah, I'll take that question. Sure, thank you. This is Vikram. I think it is still a while away, but I think what I would leave you with thoughts is what we have seen and experienced in the world around us, outside of India, where at least in a composite license regime like the rest of the world in most economies, TPAs are the dominant partners to composite license players that sell both health and life insurance policies. TPAs become an integral part of that servicing ecosystem or that administration ecosystem. And I would, if I draw any learnings from that, I would say that our market, given that we have already begun to see increased life insurer interest in our own portfolio, we will continue to see the participation with life insurers who will form part of that composite license regime.
Thank you so much for the answer. All the best.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. Next question is from the line of Pradyumna Chaudhary from JM Financial. Please proceed.
Yeah, hi. Thank you for the opportunity. So, my first question, maybe I missed it. Could you please tell the organic growth in Q3, organic revenue growth?
Your question, Pradyuman, is the fact that you want to understand the organic revenue growth for Q3? Is that the question?
Yes.
Is that the right question, sir?
Yeah, that's the right question.
I'll ask Satish to respond to that.
All of the revenues are based on retaining the existing customers, both from Medi and from all of the acquired businesses. And of course, we continue to add new corporate accounts and new insurer relationships on our own. And it's a blended growth for Q3.
I think, Pradyuman, it's important to understand that we are on a 12-month renewal cycle. As a business, and all of the growth that we see comes to us either from the same account renewing itself or new accounts moving to us. So all of our growth that we see post the acquisitions is all organic.
No, but at least if we exclude the recent acquisitions, Raksha and another one, on a like for like basis, what the growth has been. I was just trying to understand that.
Pradyuman, appreciate that. I think what I was trying to illustrate to you is that we don't tear apart these, because all of these Raksha and all other acquisitions that we have done all come up for renewal in the business and form part of the organic. These are every 12 months that we renew a customer, so they become part of the organic portfolio, and we do not differentiate between organic versus inorganic, because once a TPA becomes part of what we have acquired, when a renewal comes, the renewal is a renewal of the policy, and thereby it becomes part of the organic growth portfolio, which is where we were sharing with you that we continue to maintain a stable and strong retention rate and have not lost any customers in the MedVantage example that we gave you earlier in our recitals.
Understood. And second, by when can we expect the margins to return to normal levels, considering that we've lost a few percentage points here and there because of integration and one-time expenses?
I'll ask Satish to answer that for you.
Yeah, thank you for that. I think we've always said that it takes us about 4 quarters to completely integrate an acquired TPA and then flip them into our operating template. So MedVantage is completely done. It is a small acquisition. Raksha is a material acquisition. We just finished the first quarter of integration, and we're still holding on to the margins from H2 to Q3, despite Raksha being there for 1 quarter. So I think 4 quarters is what we typically look at for the synergies to come back.
A couple of quarters, you said. Sorry, I didn't get that part.
So we spoke about 4 quarters, of which Raksha we have completed 1 full quarter post-acquisition.
Understood. And one more question was, recently there was news that a particular insurance group had acquired one of, I think, the third largest third-party assurance company in India. And logically it makes sense, right? The idea is that these insurance companies do not want to go and start setting their TPA service from scratch. So either they can tie up with one of the TPAs, or they can just go out and acquire a TPA if it's available at cheap, like how you guys have been also in the past acquired TPAs whenever it was too cheap and whenever you got new addition in terms of client or geography. So in that sense, what impact would this have on you guys? Like if one of your clients an insurance company goes out and directly acquires a TPA?
I'll ask Satish to answer this for you, Pradyuman. Thank you.
So even today, whether it was through an acquisition route or built homegrown, every single insurer that we work with has the TPA capabilities today across the board, and all 27 of them. So we continue to win business based on the core value proposition that we've always articulated in terms of our ability to understand group benefits better, drive superior retention for the same insurers, and bring in technology, expand cash flows, and more importantly, be with neutral party that actually focuses on balancing all the different perspectives that need to be brought together across insurer, policyholder, and the network. And that's where we've consistently grown because of our focus on the core value proposition and being neutral. And that's what, and we expect that as long as we continue to deliver on this core value proposition, and we will continue to maintain our growth irrespective of any other market dynamics. Now, from the specific question that you asked, we like to think that given that within a span of a month, one of the TPAs is part of a listed company in the country, and the other TPA is part of one of the largest industrial groups in the country, only goes to show that the TPA industry is coming of age, and we like to think that the professional and superior managerial talent that will come into the industry will only be good for the overall industry.
Understood. Really helpful. Just one clarity on dividend policy you guys are following, considering our business model should ideally ensure a very good free cash flows going forward. So what's the plan regarding the cash flows?
So, Neeraj will answer this for you.
Yeah, hi, Pradyuman. So our dividend policy remains the same. We can go up to 75% of the current year's net profits and 25% of the reserves of the previous year as a maximum dividend payout. We have consistently been a dividend-paying company in the past, and I think that is a very important area for us to focus on the future as well. So we intend to be a dividend-paying company going forward. We can't give you any more clarity in terms of timing and quantum, but that policy still remains.
All right. Thank you and all the best.
Thank you.
Thank you.
Thank you. Next question is from the line of Sahej Mittal from 3P Investments Managers. Please proceed.
Hi, good evening, team. Am I audible?
Yes, you are.
Hi. So a couple of questions. So firstly, on this Raksha's contribution to our PNL, right? So when I was going through the RHP, Raksha's merger was done around 25th August 23, right? So only 1 month's revenue was considered in the 6 months financials, right? And the contribution to revenue was 6.4 crores and PBT was somewhere around 3 odd crores, right, for a single month. So for the 3 months for this quarter, ideally, the addition to our top line should have been 18 odd crores, right? 19 odd crores from Raksha alone. But if I look at your top line, the addition on an absolute basis has been close to about 4-5 odd crores. So where's the disconnect out here? Is it that there's been some loss in the business from Raksha, or how's it?
Sure. Satish will just take this to you. Thank you.
Yeah. Thank you. I think this September was the only month that we had consolidated Raksha for Q2. That was more, it did have a little bit of a one-time benefit from an integration of the accounting and the revenue recognition side. That's not necessarily the run rate of that business that is acquired. But if you look at the past 2 years, Raksha was about a 60 crore revenue top line business. And we are closer to those run rates from a revenue perspective right now.
So what's the quarterly run rate for Raksha's top line?
We'll be about 4+ crores a month, approximately.
Sorry, I didn't catch the number.
A little over 4 crores a month on a run rate basis.
4 crores a month. So even then, from a 2Q to 3Q, 12 crores don't seem to add up, right, to the top line. Or am I missing something out here?
No, it is part of the overall top line. Like, just to refresh, one of, like, we recognize revenue on a 1/365 basis for every policy. And depending on the timing of the policy and when it starts, our revenue recognition is on a 1/365 basis. And after the acquisition and including some of the accounts that got transition, there was a bit of a one-time benefit in Q2. But we've fully aligned that to how we manage our revenue recognition from an accounting perspective. And then in that model, the run rate is about 4.5 crores a month.
Got you. And
as a result, we deferred a large portion of the revenue. That is, so we've earned the revenue, but the unearned revenue portions are higher.
So that will come in the first quarter next year.
It's a continuous process. Like every day, if you look at our revenue, it is a combination of all the revenues that we accrued over the previous 365 days, and hence this will keep accruing to the future periods.
Got you. And on the staff cost, there seems to be a large bump up in 3Q. So is this purely on account of Raksha's P&L being merged into Medi Assist, or if you can give out the staff count in 2Q versus 3Q, and what's the reason for such a sharp jump?
Go ahead. I'll hand this over to Matthew.
So the staff count is because when we looked at the first 6 months, we had only 1 month of Raksha. Now we have the full number of Raksha coming in. And hence the employee cost has also gone up, and that's the reason. You see the full quarter of the impact coming in there, quarter cost.
So going forward, this kind of a bump up will not be there, and 70 odd crores is a normalized run rate for you guys. Is that a fair understanding?
That necessarily I do not believe is a fair understanding. There is a one-time post-merger integration that is currently underway. Satish had clarified in his statement earlier that it takes us 4 quarters to move the rationalization of people and cost across the entities. And so we will see and continue to hope to see further synergy in the cost structures, as today Raksha is a profitable entity, not at the profitability that we are at, but we will continue to see that accrue to us over the following 3 quarters.
Got you. And team, one last question. So if I look at the industry's group health insurance premium numbers, right, for private and PSUs versus SAHIs, what I see is that the PSU players have been witnessing a sharp slowdown, right, in the numbers, versus private multi-line insurers and SAHIs have been growing at a very fast pace. So even if PSUs face a sharp slowdown, and and if some corporates move from PSUs to private or SAHI players, even then in that case, what would be a growth outlook for the next 2-3 years?
Mr. Vikram, I'll give you a perspective on historically how it's worked for us. I think one of the central themes and tenets of our proposition has been that while the customer could be insured with a PSU, private or SAHI insurer, we have continued to remain the choice as a TPA, irrespective of the carrier. Historically, we've seen that play out over and over again. And at this point in time, given the fact that there is policyholder choice, which is exercised by the employer or the group very actively, we do not see an impact if indeed there is a reallocation of business between one carrier and another.
Got you. And your growth guidance for maybe FY25 and 26?
I think at this point in time, the guidance that we would like to give you is that we will grow alongside market.
Got you. Perfect. And all the best. Thank you.
Thank you.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and one. We have our next follow-up question from the line. The next question is from the line of Akanksha Tandon, an individual investor. Please go ahead.
Hi, my question has already been answered. Thank you.
Thank you.
Thank you.
Thank you. Next question is from the line of Chintan Sheth from Girik Capital. Please go ahead.
So thank you for the follow-up. Couple of bookkeeping on the as of December unbilled revenues as well as contract liability sitting on our balance sheet.
I'll hand it over to Matthew.
Contract liability, deferred revenue, we talked about. How much is that?
Yes.
206 crores of contract liability is there on the balance sheet. And that again will get amortized for 1 quarter, and the contract getting renewed during this will add to that. So we do a 1/12 on every policy that is the premium that we get. So 206 is as of December. The current period, whatever policy gets renewed will get added, and there'll be this, it is the release into the P&L also on a monthly basis.
Correct. And what about unbilled revenue?
Unbilled revenue and has come down. I mean, overall, let me give you the DSO numbers. Just giving you the perspective on unbilled. I think our DSO was 137 days, including unbilled as of December. As of September, and now as of December, it has come down to about 105 days. There is a significant reduction in the unbilled.
Okay.
And the billed component.
Okay, cool. And in terms of yield, we have seen some on the 9-month basis also. We have seen, the premium collection growth has been 35%, while our core revenue growing at 32%, and we have seen some marginal that implies a marginal slip in the yields. If you can highlight in terms of how the mix is driving, or whether the integration related contracts which are low yielding businesses which is driving that yield compression, or how should one look at on an annualized basis for this year and next? If you can just give a sense on it.
Sure. Thank you. Satish to answer this one.
Sure, Chintan. I'll try and explain this. One, from a premium growth, because these are premiums we are serving, and they come in at full value from all of the acquisitions, because we have continuing obligation to serve the premiums, right? Mm-hmm. But having said that, we don't book all of the revenues. We book revenues only from the date of consolidation, while the premiums are fully there, right? So we're operating in it. We haven't necessarily taken all of the revenue. Secondly, of course, like I said, the yields are more a combination of the products that we continue to serve, including retail. So we are marginally in the same ballpark as the yields that we are from a blended perspective. And lastly, the deferrals, like I think you already asked for the contract liability and unearned revenue. Mm-hmm. Clearly, that also plays a role. Especially as we align the accounting standards of all of the acquired entities, the deferrals are also slightly on the higher side.
Okay. So another aspect I wanted to understand on the cost side, if I look at our other OPEXs, large chunk of it is related to subcontracting cost. If you can just help us understand what are we subcontracting, and how should one look at it going forward? What is it related to basically?
So this is Satish here. I will take this, and if needed, I'll get Matthew to add on. Subcontracting predominantly comes from 2 parts for us. The large part is the government side of the business, where the contracts are time-bound contracts, and hence it's a significant portion of our headcount is part of the subcontracting side, purely on the government business side, because these are fixed-term contracts. Right?
Okay, it does not. Those employees does not include in the employee costs that segment. business which are the employees which are resourced for government contract.
That is correct. Almost all of the government project staff are in the subcontracting cost because these are very fixed tenure projects. Right? And secondly, of course, we also use multiple services for some of the entry level jobs, including the data entry and the calls, etc. Where those are more in line with the transaction volumes that we have. And that is where technology is coming in and making sure that the growth rate of those parts is not in line with the growth rates of the underlying transactions. We do a fairly decent job there.
Right. Got it. And lastly, on the provisioning of debtors, the ECL part, if you can help us, that seemed to be a little higher if I don't consider the unbilled portion on the notes to accounts. But if you can explain, given that these are all fairly mature claims which we are putting in with the insurance companies, why do we see such large provisioning or ECL provisioning relative to the receivable days?
Perhaps Matthew, our CFO, to answer this for you. So our ECL policy is not, when you look at ECL in our books, it does not necessarily mean bad debts.
Right.
Our ECL policy, let me explain this to you. Our ECL policies, any receivable greater than 365 days, we take 100% provision for it, irrespective of the recoverability.
And largely it will be related to government businesses or public sector insurance companies?
No, it doesn't matter. Irrespective of government or public sector, we'll take a provision for it. And any receivable greater than 180 days, we take a provision of 25% for it. And any unbilled greater than 180 days, we write it off 100%. And then only when we can bill it, we take it back into revenue. So it doesn't come into the revenue at all. So that is why that is the receivable policy. And when you go with a strict policy like the ECL, provisioning will always come higher than what it normally is in other companies or similar businesses. So we have a stricter policy. But the ECL that you're seeing now, that is existing on the balance sheet, which is about 15-odd crores, is actually from the ECL that we have taken over the past years. If you see the last 2 years, the trend in ECL provisioning has been lower. I mean, we've been able to collect because we've got better at collecting the money that is priced in the market. And that is a reflection of our DSO. If you look at FY21 versus today, it has moved from 141 to 87 in last year, and now we'll be back in the same range hopefully by the end of this year. So.
Okay, got it. And lastly, on the regulatory. Okay, I'll turn back. Thank you. Yeah, sure.
Thank you.
No problem.
Next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the opportunity. 2 questions. First, you said for next year we can expect revenue growth to be industry. So is it that we are...
Sorry, we lost you there, Anand. Can you repeat yourself, please?
Mr. Bhavnani, may we please request you to use your handset to ask a question?
I am using handset. I'll try once more or else I'll come back.
This is better.
Yeah. For next year, we guided revenue growth to be in line with industry growth. So does that mean that we are not expecting any yield compression in the near term?
I've asked Satish to answer this for you. Thank you.
Sure. I think from a premiums perspective, we've always grown at or faster than the market growth rates, both in group and retail in as many years. So of course, the premium to revenue translation is based on the nature of the products that we will continue to acquire from the insurers. But at the core or the base employee policies or the base products, the yields have been fairly stable from a range perspective. As we continue to add, more and more, outpatients or top-ups and various other kinds of products, there is a fair bit of a mix in the yield.
Okay, so if I understood correct, your guidance was more for premium growth for us and not the revenue growth.
That's correct. Our revenue growth has been in line, but also because of our revenue policy, that we defer our revenues over 365 days will always be slightly lower than the premium growth, marginally lower than the premium growth.
Sure. The second question is around transaction where one of the conglomerates acquired a TPA. I had to understand if we were in the fray for the acquisition and how did it go, or we chose not to participate. If you can give us some color around our approach to that particular opportunity.
I think, with reference to the specific opportunity, as an organization, I would not like to comment on what it is. But as you know, we continue to look at opportunities where we see significant synergy from either relationships and or accounts which are logos. So really on this specific opportunity, I would not be able to comment.
Thank you.
Thank you.
Thank you. Next question is from the line of Bhuvnesh Garg from Magma Ventures. Please go ahead.
Yeah. Hello, sir. Thank you for the opportunity. Just a question on a National Health Claim Exchange. You said that you have done integration. So just want to understand that how it will work and what impact it will have on our revenue or profitability. Yeah.
So thank you very much. I'll ask to answer that.
Thank you, Bhuvnesh. And just to take a step back, today the cashless network and the cashless claims work with hospitals actually being able to send real-time requests and receive real-time responses from insurers on the TPAs. That's how the whole cashless network works. We were among the earliest to have developed a technology interface where we have received and we continue to receive over 80% of all of our cashless requests electronically through our integrations with multiple digital platforms that are connecting with insurance companies and with the hospitals on the other side. National Health Claims Exchange is an initiative to standardize how payers and providers talk to each other electronically, and we are fully integrated with NHCX. And given our ability to integrate with multiple other platforms, and we've been fairly quick in implementing 100% of the use cases of NHCX. And multiple insurers today are leveraging our integration to enable their integration into NHCX from that perspective. But from an efficiency and operations perspective, we hope that NHCX will eliminate even the other 20% today, which is currently not in the electronic platforms.
Just to support what Satish said, I think the NHCX effort and endeavor from a Medi Assist perspective continues to remain an accretive endeavor in us being able to enable our insurer partners and the ecosystem of consumption of healthcare services as being a key partner in integrating with NHCX.
Sure, sir. Sir, I was asking in terms of revenue or profitability, etc. So would it have any impact, or how should we look at it?
We do not expect to see either accretion or loss of revenues on account of the NHCX engagement that we have and integrations that we have.
Okay, sure. And the second thing was about a recent announcement on everywhere cashless claim. So just want to understand that would that have any impact on our operations, or how would that impact our operations?
I think Satish had responded to that earlier in the call today. In summary, we are already along that journey ahead, we believe, of the ecosystem. And it only is a strong enabling provision that will just make cashless access far better within our ecosystem, where Satish talked about cashless hospitalization electronically at 80% already. This will only help us improve that number even further.
Got it. Understood, sir. Thank you and best of luck.
Thank you.
Thank you. Next question is from the line of Piyush from Equint. Please proceed.
Hello, sir. Congratulations on listing. Sir, regarding the acquisition by the private insurance guy, I had a question as to should not some of the volumes move to neutral third-party providers like yourselves? So your growth should be actually higher than the industry in the interim?
First of all, thank you for congratulating us and thank you for being on the call. I think you posed a question that has more than one answer. Clearly, one fork of the conversation could be that this business will co-locate with that one insurer and become a quasi-captive. But I think it will, and it's not really fair at this point in time for us to assume how that will play out. But the independence of TPAs has been the key backbone of TPA penetration, not only in India but elsewhere in the world.
Just to understand, there's also a lot of insurer-specific data that the TPA handles, and you would maintain silos, right, when the data is not exchanged. So, is it possible for an entity to be an independent? Is it possible for a TPA to be an independent entity and be a subsidiary of an insurer, wherein other insurers are working with that? Do we have a case like that wherein
it would not be fair for us as a company to answer that question? As a TPA, we clearly understand our data fiduciary requirements, and under the PDP Act that is expected in India, which is the Personal Data Protection Act, these questions will be asked of each one of us. But I'm not in a position to answer any questions around conflict of interest in one insurer and a TPA aligning themselves.
Sure. Thank you.
Thank you. Ladies and gentlemen, we will take this as the last question for the day. I would now like to hand the conference over to Mr. Neeraj Didwania for the closing comments.
Thank you so much, everybody, for participating actively. We are available offline to address any further queries you may have regarding our business and financials. We look forward to further interactions and staying connected. Please do write in to us at investor.relations@mediassist.in to be added to our mailing list. Thank you and have a good day.
Thank you. On behalf of Medi Assist Healthcare Service Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.